How do you know you're on track if you don't have any goals? Hi, it's Elena of Financialdemics, and right now we are doing a video series on beginner investing. Today we're going to talk about your investing goals, because I think sometimes when we decide we're going to start investing, we just start and we just go, which is great because you're taking action. But there should be some investing goals in mind. It doesn't have to be no big like research project or anything like that. It's just like, what are you looking to achieve with starting to invest? So let's talk about setting some of those goals, and then we're also going to talk a little bit about risk. Now, as I mentioned, this is a series. So in the last video, I talked about why you should start investing. So if you haven't seen that video, after this one, I want you to go back and watch that one so that you can hear about why you should start, but then also the different types of investments you can invest in. When I decided I wanted to get my CPA, I had decided years ago, like years ago, that I wanted to get my CPA. But guess what I did? I pulled down the information and then I didn't really take action. I didn't set a goal. So I said I was going to do it, but then I never took the action to actually do it. So fast forward over 10 years later, I finally came back and said, okay, I'm going to do my CPA. But this time I actually came with a plan instead of just saying I'm going to do something. I actually mapped out how I was going to actually take my test, when I was going to take my test, and an actual study schedule so that I can actually achieve my goal. And I did that because I had that schedule and the actual goals and I mapped it out. That's why I was able to successfully pass the CPA exam, because I stuck to the plan. So when it comes to investing, you want to set some goals there too, because you have some goals that you're looking to achieve, and that's what's going to help you stay motivated, especially in the beginning when you're just starting out. First, we need to define your goals. So there may be different reasons why you're investing, but let's talk about short-term versus long-term goals. So short-term goals are typically, especially in the investing realm, are somewhere between like 1 to 5 years, right? What are the things that you are planning to do in the next 1 to 5 years that you want to make sure that you have money saved up for? And investing is a way to help you do that. We talked about compound interest in that last video. So hint, if you didn't see it after this video, go check that out. But what goals do you have that you need to preserve your capital for and make sure that the funds are available when you need it? So let's think about it. In 1 to 5 years, maybe you are looking to buy a home. Maybe you are looking to get married. Maybe you have like a big trip that you want to plan for, like a big birthday or just a celebration, or just because it's on your bucket list. Maybe you're looking to pay off something, but you are wanting to see if you can increase some income while doing it. And one way to do that is to invest some money and get a return on that money to use it to pay off that debt. For items like that, right, you want to typically invest in something that's less volatile, maybe like a high yield savings or a money market fund, because you know you're going to need that money sooner than later. You don't want to necessarily take on the risk that the value in those accounts decrease when you need it. Now, for your long-term goals though, we want to invest in stocks. And so when we think about our long-term goals, think about retirement. Maybe you just have certain net worth goals you want to hit and you're doing that by investing. Maybe you are saving for your kids' college, or maybe just saving for them to have money later when they graduate. Like, this is my gift to you. I've saved this all this time. And so once they're adult, you want to be able to provide them with these funds. Maybe you are looking to have an after-tax account that you are saving, that you just have money in, and maybe you're going to use that to pay off your mortgage, or even if you're just looking to build generational wealth for your family. Now, when you are saving for those type of things, you are looking for growth, right? You want to take on the risk so you can get some growth, and that's why I mentioned things like more so like, stocks, mutual funds, ETFs, real estate, all of those type of investments into different types of retirement accounts. Because remember, on the last video I mentioned you can invest in retirement accounts or you can invest in non-retirement accounts, which are basically considered taxable investing accounts. But either way, those type of accounts would be used to hit those long-term goals that you have for yourself. If you are looking to learn how to invest better and grow your wealth, then I have partnered with One Savvy Dollar. So One Savvy Dollar is an amazing real estate and stock investor. But let me tell you about Ogechi, who runs One Savvy Dollar. She is actually going to be running a 6-week course that comes with group coaching, and she is going to basically provide you with the blueprint to be able to grow your investment account to 100,000. If you are a beginner investor and you're really trying to understand how to invest, understand like how to pick your stocks and which stocks to pick, know how to actually analyze your portfolio so that you are sticking with the right investments in your stock portfolio, then you definitely want to check out the link below to her The Blueprint to 100K investing course. It starts on January 6th, and she is going to be working with you to help you understand the stock market and which stocks that you should pick. So if you're interested, definitely check the link in the description box below. Go ahead and click on it and sign up, because you don't want to miss her next cohort that is starting on January 6th. When it comes to your investment account, you should always take your risk tolerance in mind before you pick funds or stocks, before you pick any type of investment. A lot of times people just hear what somebody else is investing in, or they hear about that one stock that's doing so well and everybody's making money and they want to jump into it. And the problem with that is that stock may not fit your personal risk tolerance. And so when that stock just drops, say by $1, you ready to pull out and run. And that is not what you're supposed to do if you invest according to your risk tolerance. So let's talk about what risk tolerance is. So risk tolerance is basically how much you're willing to deal with in terms of the volatility of that particular investment. So what I mean by volatility is, okay, if that particular investment drops by $20 in one day, are you running or you staying? Because if you're running, then you have a lower risk tolerance. If you're staying and you're going to play it out, then your risk tolerance may be higher. And so that is something that is important for you to know about yourself. I will link below a quiz on risk tolerance so that you can determine where you fall. But every investor should invest according to their risk tolerance. Please don't just try to be risky or just jump in something because you hear somebody else is invested and they're doing well. Typically, stocks that are more volatile, so that means their price fluctuates more, typically do give you a greater return. And the stocks that are not as volatile may not give as big of a return. But if you are going to jump out every time that more volatile stock drops, then it's not the stock for you. And it's going to mess with your head. I don't need you stressed out. We want you to invest, build this wealth, and not be worried about oh my goodness, what the stock is doing, especially if it's stressing you out and that's what you're focused on all the time. So I want you to check out that risk tolerance quiz I've linked, and make sure that when you are investing according to your personal risk tolerance. Now, when we talk about the volatility of a stock, I kind of want to explain that more. Typically with stock volatility, it occurs according to whatever is going on, either with market conditions, either with that company's, let's say, earnings, or maybe news that has come out about that company, investor sentiment. So investors, if they're not If investors feel like that stock is doing well and it's great, then that stock is going to grow because people are putting money into that stock. If investors feel like that stock has not been doing well, we're hearing bad news, we don't feel like it's going to last. And sometimes they think that, and that's just not realistic, but I'm just telling you, that's the thoughts. So people are pulling their money out of the stock, and of course the stock is going to drop in value. Sometimes a stock may drop just because of politics. Whatever is going on politically can affect how a stock is currently performing. And then even it could be like interest rate changes affects how a stock performs. And even if a new regulation comes out, that can truly affect how a stock is doing. I want you to think about what your investment goals are, like what you want for your life. Write them down, because there is something about writing down and achieving those goals. I'm telling you, when you write them goals down, it's a better chance that you're going to achieve those goals. And take the quiz that I have below so you can determine your risk tolerance. And if you are looking to invest, or you're already investing but you feel like you don't have a good handle on it, then make sure that you sign up for the Blueprint to 100K that I have linked down below. I'm telling you, this is going to give you what you need to be able to understand how to invest, what you're investing in, and be able to help you grow your wealth. Now, if you're trying to figure out why you should start investing after watching this video, then I will see you in this video over here.